though the marathon known as earnings season doesn't officially kick off until Friday, we got the chance to do a few warm-up laps when PepsiCo reported yesterday morning. So when those numbers crossed the tape at 6 a.m., I was ready. I mean, after all, I've been awake for multiple hours at that point. But when Wall Street got its first taste of the earnings, the initial reaction reeked of disappointment, causing PepsiCo's stock to fall almost $2 in pre-market trading. Despite the initial disgust, though, the stock finished the day up nearly 2%, and it ran another 1.2% today. So how the heck do we go from having disappointment for breakfast to delightful, let's say, post-earnings rally? I want to walk you through what happened here. It's really fascinating, but the key piece of the puzzle is that PepsiCo stock was trading at just under $180 in mid-September. And by the time the earnings report came around, it already pulled back to $167. Some of that's because money managers tend to sell defensive stocks like the food and beverage place when the Fed starts cutting rates. It's just kind of a habitual thing. But some of it's because we got an avalanche of negative research on PepsiCo going into the quarter. Morgan Stanley downgraded from overweight to equal weight on September 20th, citing weaker scanner data and worsening trends in market share. They're especially worried about the Frito-Lay business. They're also worried about North American beverage business, especially Gatorade. Well, this one downgrade was enough to send the stock down nearly 2%. Wall Street was just getting started, oversharing their negative expectations of the quarter. Because when you get one downgrade that moves the market, well, others start coming out of the woodwork, echoing the sentiment instantly. And wouldn't you know it, just a week later, we got a negative 30-day catalyst watch from Citi. Very similar to the Morgan Stanley piece, they saw lower organic sales growth, calling out deteriorating scanner data for both beverages and snacks. Citi also said to expect management to cut full-year organic revenue growth, maybe guidance from 4 down to roughly 3. Then the very next day, Bank of America joined the party with their Taylor Swift-themed hit piece titled Cruel Summer. That's right, Monday Night Football. Mad Money, you can't hide from Taylor Swift. She's everywhere. And the note, Bank of America called out, quote, persistent weakness in North American snacks and beverages, given consumption trends at the category level and market share losses, end quote. Because of this, they only expected 1% organic revenue growth, another slash. By the end of last week, it was getting pretty comical. Barclays joined the fray by outright saying in the preview note that they expected PepsiCo to cut its full-year outlook. And the very next day, RBC Capital said the company was due for a salty quarter without much chance for material upside. Needless to say, if you read these notes heading into the quarter, you knew not to expect a home run, like I do tonight from Harper. Instead, this is supposed to be a disgraceful strikeout, like I expect from Bohm. So what happened when the company reported yesterday morning? Well, it all played out exactly as it should have, wouldn't you know it? For the third time in 4 quarters, PepsiCo missed revenue expectations, organic revenue growth of 1.3%, coming in below the 2.7% consensus estimate. Not good. And just like many of these analysts predicted, much of the revenue shortfall came from muted sales in both the North American Frito-Lay and beverage segments. But after weeks of everyone and their mother telling you to expect the revenue miss for precisely these reasons, after the stock had already fallen from 179 to 167 in less than a month, there was no surprise here. So even though PepsiCo's stock got hit in pre-market trading, it eventually rebounded because virtually every food and beverage analyst under the sun already told you what was going to happen. If you were patient enough to read the prepared remarks before pulling the trigger, or disciplined enough to wait for the 8:15 a.m. conference call, management gave you several positives that were able to turn the stock around. For example, everybody's worried about the Frito-Lay business, but management said they've shifted their focus toward offering customers better values. They're advertising bonus packs that give 20% more Tostitos or Ruffles. These efforts seem to be paying off, which is why volume trends for Frito-Lay improved over the course of the quarter. In other words, the cadence got better. Same goes for PepsiCo's North American beverages business. Gatorade gaining share in the quarter. So much for that concern from Morgan Stanley, huh? And for all the worry about beverages, while revenues did miss expectations, the division's core operating profit grew by 7%, with its core operating margins expanding by 90 basis points, and that's despite a double-digit increase in spending on ads on marketing. Very impressive. This ability to generate margin expansion is important because it shows that PepsiCo can still grow earnings despite short-term headwinds that led to the small cut to their full-year revenue guidance. That is why management could reiterate its full-year earnings growth forecast of 8%. Not too bad for a simple consumer packaged goods company, and the real takeaway for many people about how the quarter really was. Management even mentioned that they'd be de-emphasizing certain low-margin products and package combinations while also accelerating productivity initiatives, meaning more automation at their plants. They say these guys cut costs every quarter. Plus, PepsiCo is very conscious of where consumer trends are going and what kind of foods they want to emphasize moving forward. When answering a question from an analyst about whether there were any structural changes to consumer habits, meaning are they getting killed by these GLP-1 weight loss drugs, CEO Raymond Laguarta talked about how the company is looking for, quote, more permissible snacks and more unstructured meals, an area where they see the consumer moving. Permissible means snacks that are healthier, while unstructured meals are more like mini meals. I think like grabbing some Sabra hummus and a banana, as opposed to your favorite rotisserie chicken spot like I like. PepsiCo already has several permissible snack items like lightly salted and baked chips, not to mention Sun Chips, Popcorners, and Smart Food. They seem serious about moving more in this direction, including with the $1.2 billion acquisition of Siete Foods, which has a, quote, better-for-you tortilla chip offering. So here's the bottom line. Stocks react to expectations, and when it comes to PepsiCo, everyone expected a real bad quarter, which is why the stock sold off so hard going into the report. But once we saw the numbers and heard the commentary, it was bad, with a few bright spots, which allowed PepsiCo to rally anyway very nicely. Now, this is something you need to keep in mind as we head into earnings season. If the stock is already sold off hard going into the quarter, it's very difficult for it to keep going down unless the numbers are shockingly horrible. Nothing shocking about PepsiCo. Mad Money's back after the break.
Coming up, part 3 of Cramer's ongoing stock screen. From one type of pipeline to another, he's got names to watch. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.